passing things to your spouse at the end of their life be the best tax planning strategy? Let's discuss. Hi, I'm Kimberly Shapcroft, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. As we get older, we end up with different things within our estate. And it comes down to, when do you do your tax planning? Now, I've got a few clients who've been planning 10, 20, 30 years, hopefully before the end of their life, and a few leaving things till probably a little last minute, where they're maybe in the 80s and 90s and planning becomes a little more tricky. However, one useful tool to be aware of is the death uplift. And what we're talking about here is, if you've got a property that is owned by a particular person, when it is passed to the next person, capital gains tax falls out of play and we go straight into inheritance tax. So if you bought a property for, say, 100,000, today it's worth 300,000. So if you sold it, if you transferred it, you're going to have to pay a gain, tax on a gain of 200,000, which is quite a lot of money. Whereas if I keep that property and I transfer it to my spouse, they will actually receive the property as if it's worth 300,000, because that's what the value of it is on your passing at that point in time. It's what the market value is. So now we've just increased the value of that property from 100,000 to 300,000 without having to pay any capital gains tax. Now, obviously, if you pass it to a spouse, there's no capital gains tax and there's no inheritance tax. Whereas if we pass that to a child, there would be inheritance tax on the value of that asset, potentially, depending how the estate fits together. So it's a useful tool to know that actually it may be, if you own things jointly towards the end of your life, you may need to do a bit of a morbid conversation, to be honest, because you're going, who's going to go first? But have a look at who is going to go first, depending who is likely to go first. Rather than own something in joint names, you may want to go through the legal process, pay the solicitors, and transfer it from being in joint names actually to being in one of the spouse's names. And it's the one that's going to go first, because then when they do go, that will be transferred in line with the will, which hopefully then says to pass it back to the other spouse. And then you pass it back to the other spouse, but now rather than being worth 150,000 each and you've just kind of got this and it's not working, you've actually kind of got, we bought it for 100, it's now worth 300. The spouse that's just inherited it has inherited it in entirety at 300,000. So when they come to sell it or do something with it, their base cost is now 300,000. It's not 150 for the half that their spouse gave to them and the original 50,000 that they had. So they've still got 100,000 gain to pay on it. They've now inherited it at 300, and when they sell it, maybe at 300 or gift it at 300 or 310, 320, whatever it may be, there's a very small amount of capital gains tax rather than this, as we were saying at the beginning, 200,000 gain, which is quite a lot to be paying tax on. Now, obviously, this can be slightly difficult because you may both be in perfect health. You don't know who is going to be going first. So it does become a bit of a guessing game, and it's kind of 50-50. There's two spouses, 50-50 on who is going to be the right person to have things in. But as you get closer to the end of your life, it may be something worth considering. Now, the other impact here is we do need to make sure your wills line up, which is not an area I get involved in, but it is part of that planning process that you need to make sure your will is aligned with the tax planning, because you can't suddenly say in the will it says we give it to our children, but the tax planning has assumed it's going to the spouse, because then all of a sudden you go, well, this hasn't really worked because now there's inheritance tax to play, which wasn't the intended plan. Obviously, in a scenario like that, which you kind of go, this becomes difficult because we've done the first step, we've moved it into one of their names, but it's gone to the wrong person. That then becomes the question of, do you introduce a deed of variation? you speak to the child that it's gone to, you go, well, actually, we'd planned to pass it to me. Then we can look at what we do, and I can look at maybe gifting it to you in the future. I'll sell it to you. We can look at how things work through going forward. But then you can kind of have that discussion and maybe put a deed of variation in place to actually bring the tax planning back into play, rather than all of a sudden that's tax paid, you've lost, well, potentially you may have had to sell the house, mortgage the house to get the funds to actually pay the inheritance tax, which on a 300,000 property, if it's all under inheritance tax at 40%, you're looking at 40, 80, 120,000 of that is going to be inheritance tax on 300,000 property, which if it went straight from one spouse to the other, there'd be no inheritance tax. And then it's a matter of looking at the surviving spouse's estate inheritance tax position, and then doing some inheritance tax planning on their estate to make sure that hopefully the family can manage the affairs to minimise any potential inheritance tax or any potential capital gains tax that may arise as potentially things are sold, cash is passed around and such like. So as you can see, this is one of those where it depends on the relationship, it depends on the position, it depends on the health, and I do appreciate sometimes this may change. One may be healthier, one may be more unhealthy, and that shifts around and suddenly something happens. So there is a few, you can't precisely plan these things, but it is an option out there which, depending on how your life is fitting together, I know I've seen couples where one is significantly older than the other, and it may be one is in their 80s and one is in their late 60s. So probability wise, there is an indication of who may go first, which then means you can do the planning in line with that. As you can see, it's not necessarily definitively easy to say one way or the other, but it's definitely worth considering, and it may be a very simple tool to use in your inheritance tax planning point of view. And I definitely suggest speaking to an accountant or a tax advisor who can discuss your inheritance tax position with you, and this may be part of the plan depending how your estate is looking. Happy estate planning and happy inheritance tax planning. Let's try and minimise those taxes where we can. Hopefully today you've discovered how it works with passing things on your spouse's demise and what the tax position is. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.